Start recording if you could, that'd be great, Lakin. So hello everyone, and thank you for coming along to this presentation on property development information session. The specific topics about opportunities with property to kickstart your investments. This is another webinar series that we're running with our clients, whether it's in business, personal or wealth. We're looking to push across some education to everyone. We found that most people actually have an interest in property or an opinion in property or the property area. Who can actually blame them? With the property market going up or sustained growth that you're actually getting, owners are wanting to get into the property game or getting into that upswing of value. With this, we're finding owners considering what they can actually do with property. So this seminar is there to sort of discuss some of the things that you can actually do with property. First, with some housekeeping, we'd like everyone to if you're not on mute already, please turn your mute button on. This is so, first of all, there's no background noise during our presentation, so you can pay attention to everything, as well as often, if you do make some noise, the screen will divert back across to you. We are recording this webinar, so if you do want a copy of the slides or a copy of the webinar or a copy of the video, we can send that across to you. Also, it will be on our socials as well. So Laurie, Tim's and myself social media bases. So please look out for them. Also, we'll be holding off the questions till the end. This is the reason so we don't get distracted, as well as if you do have a question, feel free to actually pop the question in the chat space. Lakin, the organizer of this presentation, will moderate the questions at the end. So please, if you've got a question, feel free to do it at any time. So the presenters, we've got some experts presenters today. Both of these gentlemen I've known for a while now. Both are owners of successful long-term businesses in the property and lending space. Laurie, or Lorenzo Rigoni, is a director of Terrain Consulting based in Kew. They are celebrating their 20 years of being in business. He is a town planner with over 30 years experience in facilitating the management of a wide variety of projects spanning residential, commercial and industrial development. He's a fitness enthusiast, completing a number of Spartan events and stair challenges. Tim Gasper is a director and owner of Hatch Financial Services. Tim has over 10 years experience in the finance broking space. He assists in demystifying the complicated work of finance and unlocks that power of property. He's also a Demons tragic as well. My name again is Stuart Coulthard. I'm a director and part owner of Rubiix Business Accountants. Rubiix is celebrating its 10 years of being in business. What a year to celebrate 10 years. I've got over 20 years experience in the accounting industry. I was a finalist in the 2019 Partner of the Year last year. And like Tim, I'm loving homeschooling. Topics to be covered today are on the screen at the moment. First of all, we'll cover off on the government grants, building opportunities, tax considerations, getting the finance right, and as I've mentioned, questions at the end. So the first slide, the Home Builders Grant. So this is a recently announced federal government announcements. It's specifically designed to assist the residential construction market for encouraging new builds of homes and renovations. We're actually fielding some questions about this grant with our client base, but I'd actually be interested to hear if anyone is actually thinking about using this grant or going up for this grant, because we're finding the eligibility criteria is a bit restrictive. On the screen, we're running through the eligibility criteria. First of all, it's a $25,000 grant, which is tax-free, so you don't have to pay any tax on it. To be eligible, you've got to enter into a contract between the 4th of June 2020 and 31st of December 2020. So you've still got plenty of time. It's got to be a new build. What that means is it's got to be a new house. And actually the value of the house has got to be less than $750,000. If you're looking to do a renovation, the renovation's got to be between $150,000 or less than $750,000. With the kicker being the existing property's got to be less than or valued less than $1.5 million. You've got to be an individual, so a company or trust can't actually get this grant, and you've got to be over to 18 and you've got to be Australian as well. There are some taxable incomes requirements around this space as well. So as an individual, so just yourself, your taxable income's got to be below $125,000. If you're a couple, it's got to be below $200,000. It's run through the State Revenue Office, but we've got some more information coming through as well. Specifically, the questions we have is, can it be more than one contract? Does you have to use one contract for the builder? So that's the information we've got around the Home Builders Grant. Next, I'll be passing along to Laurie or Lorenzo, just to run through planning.
Thanks, Stuart. Yeah, so my name's Lorenzo Rigoni. I'm the Director of Terrain Consulting Group. Let's go to the next slide. So what's the role of a town planner? Before I go onto this slide, I had a bit of a thought about this morning. There must be something driving why we look at redeveloping properties or looking at investment in all different forms. So I went through a little bit of an analysis this morning, and some interesting figures came up. Since 2011, the population of Melbourne has increased by an incredible 1.34 million people. And in 2019 alone, it increased 190,000 people. Several years ago, it was bubbling on around 95 and 100 and 120. So I was astounded by that figure of 190 in 2019 year. And that's derived from interstate migration, overseas migration, and of course, natural birth. And one of the driving aspects is jobs in Victoria, and particularly Melbourne. Certainly attracts a lot of employment opportunities across Australia and from overseas. The other fascinating thing which I came up with was that population density. Melbourne sits at a density of 453 people per square kilometre. The closest it comes to is actually Adelaide at 404, Sydney down to 400. So it's the most dense city in Australia, which was a really interesting comment, which gives an idea in terms of the state policy provisions for what we know as urban growth boundaries. So it's containing. What all that leads to is urban consolidation, infill development in the established suburbs. So in that context, what does a town planner do? So the first things we do, we understand the context of the land, what's permissible, what's not permissible, and how it fits into the surrounding area. Often we need to liaise with other consultants, but also it's that fine balance between state policy and local policies and the complex strategic framework. A lot of planning jargon and buzzwords, but we tend to have the ability to navigate through. Hand in hand with that, we work closely with draftspersons and architects. They put the vision into a plan form. But effectively, why they engage a town planner is to look at it objectively, to look at if it accords with relevant state legislation and policy. In many respects, I often use the term is that we're the check and balance in a project. And that check and balance is important for architect and draftsperson, but also very important for the client in terms of what opportunities there are. So as understandable, there's a lot of meetings, whether it's meeting with council, meeting and working over plans with clients, appearing at VCAT panel hearings and liquor licensing as well. So it's a multidisciplined profession dealing with a whole range of different inputs. So these are some of the inputs. It's not exhaustive. The obvious are architects and designers. Occasionally you do need a traffic engineer, such as ensuring that the car park layout to a particular development, be it a unit development or a childcare centre or medical centre works. Landscape architects are integral to greening the perimeters of the site. We also, of course, work regularly with heritage consultants. We have a whole range of beautiful suburbs in Melbourne that are subject to heritage controls. So we work closely, give guidance how to achieve. Lawyers, town planning is very much a legal field. So we work closely with lawyers in terms of interpreting legislation, also appearing at arbitration. Arborist looks at tree controls in terms of trees on properties and various overlay provisions that may be required to take into account or adjustments to a design. And ecologists, they're the biodiversity type of consultants that look at the flora and fauna corridors, particularly the green fringes of Melbourne. So what are some types of town planning permits? These by no means are exhaustive. The obvious ones is you need a planning permit for medium density housing to put a unit in the backyard or a few on the site. Hand in hand with that, you can also go large developments, apartment blocks, mixed use developments, home extensions, of course. Invariably you need a planning permit for most home extensions in heritage areas. Brownfield sites, it's a planning term whereby you're converting an industrial parcel of land or industrial use surrounded by a residential area, which is more suitable for a residential type of use or mixed use. So that's why you see industrial precincts being converted to these type of residential buildings. There's a whole range of uses also that you need a town planning permit for. Commercial uses, restaurants and cafes, liquor licenses come into play in that regard, and offices and shops. And as I mentioned before, medical centres and childcare centres, these are uses that are also allowable both in commercial zones and also residential zones. So there's a lot to consider in the planning process. I've included a chart. This is a simple flow chart. It could be variable in terms of which stage, but in essence, once you have the plan, your proposal complete and ready to lodge, you lodge through council, and then it's assessed by the council officer. Invariably, the council officers review a proposal and they send a request for further information letter. They may well refer the proposal internally to council departments, or in the case of main road frontage uses, for example, to Vic Roads or the Department of Planning. You take those referrals into account in a response initially. Quite often, the applications are advertised. That's the sign that you tend to see in front of properties, and the community has, in the order of at least 14 days, they can view and comment on a proposal. Then there's the assessment of the council officer, and that could also include the assessment of all the referral, would include the referral authorities and also the objections that's received. And part of that process is often a council consultation meeting with community submitters or objections, and then ultimately a decision of council of the officer. And that could either be done what's known as under delegation without the need to go to a council meeting, or a council meeting where the proponent being the applicant, any submitters put submissions to the councillors and they make a decision. Hopefully most of the time that's where it ends, but there's also the other variable, which is VCAT. If the matter is approved by council, but objectors feel that they want to review, they can refer to that to VCAT, which is a Victorian Civil Administrative Tribunal at state level. Equally so, an applicant could appeal and seek a review if council denies a proposal, or it could also be as simple as reviewing a condition on a planning permit. So they're all variables at the VCAT stage, but that's a bit of a snapshot in terms of a complex process. So there's a lot of stakeholders in the planning permit, and it's more than just simply the architect and the client. Obviously, the two are very important stakeholders in any planning permit. The town plan is what navigates it through the process. As I said before, the checks and balances. But before you even get to the planning permit stage, you need to get input in terms of financing before you purchase the property. One may go to an accountant, of course, to establish the structure of the purchase, whether it's a trust or company structure. The real estate agent has a big role in that. The real estate agent may assist you to looking for your investment property or assist to negotiate a purchase. It's a good idea to speak to a builder, probably sooner rather than later, at least when the first concept plan's prepared, so you get a bit of an idea of cost. Council, of course, is a key stakeholder through the planning permit process, and the conveyance and the lawyer comes at the start of the process at purchase, and also at the end of the process when you develop the site and it's sold. So there's a number of players that come through the planning permit process itself. In terms of three areas I'm going to focus now, dwelling additions and medium density housing. So there are residential zones in Melbourne, and for that matter, they're across the state of Victoria. The more typical zones are these three: the neighbourhood residential zones. And if you're looking for an investment site, be mindful of a few of these considerations. It's 2-storey maximum height. Now, the neighbourhood residential zone, whilst you can put units on the property, it tends to be of the lower yield as compared to the general residential zone. The general residential zone can get up to about 3 stories in height, in most cases 11 metres, and it anticipates greater numbers. The zone that has most development potential is what's known as a residential growth zone, and that can have 4 stories plus on the property. And these are zones that typically have got a lot of strategic planning support in the planning scheme. Other areas are such as heritage controls. It's not the case you can't do development heritage areas, but there's certain things to look at. For example, you need a permit to demolish externally to building. In most cases, you need a planning permit for painting and colours. And for extensions, you could do first floor extensions. It's all about view lines from the opposite side of the street. So a lot of councils have policies that give guidance in terms of view lines and how it fits into the context of the heritage streetscape. Heritage consultant input is one of the consultants we regularly work with, and that's very useful in the early stages and through the process. The provisions we look at for single dwellings, clause 54, and for medium density is clause 55. So that's where town planner comes involved and works closely with the architect in terms of ensuring that the design fits in terms of council's regulations. So here's some example. For example, the development at the top is a heritage dwelling. You can see it's a terrace in a city. This is a property in Carlton. And the after shots to the rear, you could see how it's got the first floor extension positioned more towards the rear of the property. So the facade of the building is, the heritage integrity is retained, yet the accommodation for the family is ensured in terms of the rear additions. So this is a successful particular project and how you're managing through the council process. Medium density housing, again, before and after shots, a corner property. This one's in Ivanhoe, and you can see in terms of the end product, it's a contemporary development with flat roofs. Neighbourhood character comes into play. Some councils are quite supportive of contemporary form. Other councils would prefer more traditional type of form with hip roofs. So it's working through the details of the planning scheme and what the character policy refers to. Then you have apartments and mixed use development. So here's a few examples in terms of mixed uses. Mixed uses, often cafes and restaurants, perhaps shops at ground level and apartments above. They're typically very contemporary, quite modern. If you notice, they tend to have podium levels and then setbacks to the upper level. And importantly, the height is determined by a range of overlaying controls in the planning scheme that give a direction for height. So the investor, the architect, the project team and the town planner knows what the maximum you could achieve and what council's expectations are even before it's lodged. So when you purchase one of these sites in a mixed use or residential growth zone, the parameters are set already in the planning scheme. So apartments and mixed use developments, where do you look for? You can do apartments in general residential zones. The qualifier is it needs to have policy support. So that's where it's tucked in the planning scheme. The great sites is obviously the residential growth zone, where it anticipates apartment developments. There's also a mixed use zone, and those heights very much vary, and they've got strategic support. The commercial one zone is typically your strip shopping centres, where you can have the cafes, the restaurants, the shoe shop, the butcher shop, and the apartments. And that's where you're having that activity in terms of cosmopolitan activity within those precincts. You have an activity centre zone, and most commercial zones in and around Melbourne, whether it's Turk Road, Chapel Street, the high streets, Preston North, the Sydney Roads, Coburg and Brunswick, through Bentley, any of those areas, activity centre zone, and they've got a lot of strategic support for those areas. And the comprehensive development zone, there's very broad planning provisions and actively encourages development. And all of those zones have an expectation for high density. And why is that? There's a lot of strategic support in the planning scheme that gives clear direction up front. So that certainly assists if you're looking at these particular zones. You'll find that within the planning scheme, there's a lot of policy support. So the other opportunity you might look is land subdivision. It could be something as simple as subdividing a parcel of land to the rear of your property to either sell the lot or to put a dwelling, or it could be a multiple lots. You could be in the fringes of Melbourne or an area in the growth zones or a larger lot. One of the things to look at is that as planners, one of the things you need to look at as investors is the zoning. Often there's minimum lot sizes. For example, on the outskirts of Melbourne, there's a lot of farming, a lot of land in rural areas that have an 8 hectare minimum lot size. And there's no discretion there. So you need to have a look at the schedule, that's important. There's also planning overlays. You could have vegetation controls, bushfire considerations, and also flood-prone land and some parts along the coast, even subject to sea level change. So that has a bearing on subdivision as well. One of the things you should look at is easements and restrictive covenants on title. Easements such as a Melbourne water electricity easement, generally along the back boundaries, but just check to make sure it doesn't run diagonal over the property. That could have a bearing in terms of siting a built form over that area. Restrictive covenants, the most typical one are single dwelling covenants. Need to look at the fine print, and often it's the second search in the title that brings up the details. So speak to your conveyancer lawyer and make sure they do the extra search. If you purchase a property, it only says one dwelling house, that's all you can do. It's very difficult to lift through a variation. You look at the site, you look at the orientation, you look at the slope of the land, and also look at the strategic policy. Council might have a clear expectation for change, either for change or against change. Local politics comes into play, and often that's not within the planning scheme. It's the lie of the land in terms of politics. So speaking to local consultants or consultants that do work in the shire, the municipality, can give some guidance in terms of whether councillors are likely to form their view with relation to land subdivision. And finally, here's a few examples in terms of what the example to the left is a greenfield site, which is a vacant land. You can see there's connections to adjoining roads. What we look at in terms of the orientation of the site to have good solar access. We need to also design in terms of width of the road reservation, so there's enough room for services to and from the property to serve future development. The subdivision on the right is a little bit less orthodox, and in that sense, you can see the allotments have varied in terms of given the shape and the proportions of the site. So each site is different, and that's where you have input through various consultants. But the important thing, there's some great opportunities in those three type of scenarios I've put forward. Thank you.
Thank you, Laurie. So Laurie's established what you can do with the property and some of the checks and balances that you can go with a property. But what about tax? As I mentioned, a lot of people at the start of the presentation, a lot of people do have an interest in property, and sometimes they come to a point where owners want to actually do something with their property. We field a number of questions about, around property, be it from property development businesses to mums and dads looking to do something. How much tax will we pay is often the main question. It's my home, that's exempt from tax, isn't it? What about GST? And often my answer is it's complicated and it all depends. It depends on the intentions of the owner and the facts of the case, and depending on those two things will depend on the tax outcome. Our advice is often to speak to us before the transaction actually occurs, because it's really hard to do really anything or provide a solution once the transaction has actually occurred. Why do we mention this sort of thing? Is first of all, the ATO are in the back of most property transactions. Property and tax is not cut and dry, and there is a bit of a grey area in terms of tax and the ATO judgments. The grey area has led to a big focus by the ATO in the property space. So more often than not, the ATO are chasing GST in relation to property transactions, as well as chasing income tax when a property has been sold. The ATO puts out an annual numbers of what they actually expect to collect in relation to GST and in comparison to what they actually get. And the ATO view that a large reason for their variance in those two numbers is due to property not being properly declared in relation to a property sale. So with this, the ATO focuses on the property space. The ATO view the building industry at risk of phoenixing. Phoenixing means where a business actually, a builder's business will actually liquidate or go bankrupt, and then the next day open up a new business, where that liquidated businesses basically have walked away from their tax liabilities, amongst other things. Again, the ATO are really active in this space, the property space. In the 18 financial year, they did 3,500 audits, raising $420 million. And more often than not, they have a high success rate in any audits in terms of the ATO space. So getting the paperwork right, getting the right advice at the start is really important. And more often than not, the ATO know the property have been sold, as well as the State Revenue Office who looks after stamp duty. So the questions that I often get is, as you'd expect, the ATO have provided detailed guidance on how to treat property transactions, which I'll run through a little bit. But the comments that I often get are, what area of tax am I actually going to fall into? But my comments are, it's very complex and the advice can vary depending on the circumstances. So this presentation is just a guide, so please talk through your specific circumstances with us first. Now, if a property is actually sold, there can be 3 tax treatments. First, it'll be capital. This is the capital gains tax area, and this is where everyone wants their circumstances to be. This is first of all due to the concessional tax treatments when you classify a sale of a property. The capital area includes the main residence exemption, where you don't actually pay any tax at all on the sale of a property. And it also includes the 50% CGT discount if you're selling your property. So that's an area where everyone wants to be, because all of a sudden you're paying half the tax. The profit-making undertaking space, or the enterprise space, this is where most property development transactions will fall into. This is where you are deemed to be running an enterprise, which is not the business of property development. So what you'll be required to do is get an ABN, potentially register for GST, and pay income tax at your marginal tax rates on any profit. I note the ATO view, anytime you make a profit from a sale, they want you in this area. They want you to deem your profit as a profit-making enterprise. If you're in the business space, if you're running a business of property development, there is different set of rules again for property transactions. Essentially, they treat the buying and selling of property like trading stock. We usually advise a lot in this space about structures, protecting your assets, as well as saving tax as well, on tax minimization strategies. So determining where you sit, be it capital, profit making, and business, will determine your tax outcomes. And some of my questions that I have for this is, what are your intentions? And your intentions can change as well. Are you intending to make a profit, or are you just intending to make an investment long term? Are you carrying out a business? Are you going through the activity of making a business as well as making a profit? So now that I've gone through some of the capital tax treatments, sometimes it actually isn't easy to actually determine where you are, and the ATO do view that line can be blurred. Here on the screen is a number of factors that can assist in working out if you are in the enterprise or the capital or the business of property development space. These aren't a cover-all as well, but also if you're ticking off a number of these as well, you actually will determine whether you're an enterprise or a capital. There's no single one factor that will determine your outcome. As mentioned before, if you are an enterprise, it means you are in the GST space, then GST may have to be charged and income tax will have to be calculated. I note there are concessions available as well that could reduce your tax outcome, being if you lived in the property, is it a farm? If you can actually claim the cost of the build as well as any GST associated with the build as well. But some of the, as I said, some on the screen is some of the factors to consider. Whether you've owned the property for a long time can determine whether it's capital or business profit space or the property of the enterprise space. Was the property of private residence? Often you do get an exemption if you live in it for a while before you actually do any sort of development. Was it your holiday home? Is it an investment property first? The next is your activity, or are the things that you're doing all about making profit or all about running a business? If you're doing those sort of things, the activity that you're actually making can push you towards being in the enterprise. Are you registered for GST? That often is a determining factor when determining if you're in the enterprise. Was the property that you owned in an urban fringe or being rezoned, and all you've done is split it up and sold it? Then you may be on the capital space. But if you've specifically gone into that area, bought, developed, put property on it, you could be going into the enterprise space or the property development space. Was your intention to engage in a business? So again, obviously that's pushing towards the enterprise. The size of the profit, the dollars involved, the loans involved as well can push you into or be a determining factor of where you sit in the tax treatment space. How sophisticated the development is. Are there pre-sale arrangements? So again, the sophisticated, the detail, the number of activities push you away from just a mere realisation. And then there's a few other factors there as well, which I can go through later on. So I just wanted to quickly run through a couple examples that we often see. So mum and dad, they've lived on a large suburban block. Often the council has recently changed their bylaws to allow smaller lots in the area. They've decided to simply subdivide the land to allow their child to build a house into which to live. They've arranged for the approval and the subdivision through the council for the land to be surveyed and for the title for the new blocks to be transferred to the child. She pays for all the costs of the subdivision and the cost of the new house. Mum and dad are not carrying on an enterprise in this specific example, as the subdivision without any commercial aspect, and it's part of a private and domestic arrangement to provide a house for their daughter, and that's it. They haven't gone out and not running a business. The next example, mum and dad live on a 2.5 hectare lot that they've owned for more than 30 years. They've decided to sell part of the land and applied to subdivide the land into 1.25 or two 1.25 hectare lots. They survey and subdivide. The subdivisions are approved. They retain the subdivided lot containing their house and the other is sold. Mum and dad are not carrying on a business or an enterprise in this circumstance, as the subdivision and sale are a way of disposing some of the land on which the home is situated, so the home where they're living. And it's just a mere realisation of the capital asset. This example 3. So again, this is not my mum and dad, this is just, I've changed the name. They're living in the same house on a large block of land for a number of years. They've decided that they would like to move away from the area to develop a plan to maximise the sale proceeds from their land. So the intention is to make a profit. They consider the best course of action is to demolish the house, subdivide their land into 2 blocks and build 2 new houses on each block. Mum and dad lodge the necessary development application with the local council and receive approval for their plan. They arrange for the house to be demolished, the land to be subdivided, a builder to be engaged, 2 houses to be built, water and telephone and all the utilities to be put onto the market, and also get the real estate agent involved as well. Obviously, mum and dad's plans are to make a profit. They are an enterprise, so they will pay income tax with some concessions. They are an enterprise based on the activities. They've gone over and above just mere realisation, the asset. But there will be opportunities for concessions there as well. So in this example, I thought mum and dad should probably lay off the real estate agent property development space. So Steve buys a 100-acre property. He decides to subdivide the property into 1 hectare lots and sell these. He's engaged a town planner, surveyed the 100 acres, and actually established that he can subdivide into 65 lots. Stephen consults his accountant and legal advisors. Together they prepare a comprehensive business plan for the project. They approach a commercial lender to arrange a substantial loan and to secure the property to cover all the development costs. So you can see that he's actually going about it in an actual business manner. He's engaging a lot of professionals and he's really involved, and also the size of the actual development. So he's not going to be in the capital space, he's going to be in the enterprise space. So you can see there's depending on the factors, depending on the circumstances, will depend on the tax treatment. So there's not one cut and dry space. So I've mentioned before where there's GST involved, there's often GST in property. So here's a little table that we often run through when determining GST. So first of all, with commercial property, there often is, if there's a commercial property sold, yes, there's GST, but there's also potentially to be no. So if the commercial property can be deemed to be running a business, there's something going to be called a going concern, so no GST as well. If a residential property, an old residential property is being sold, there's generally no GST. But if a new residential property is sold, there's often GST on top of that as well. But you can access the margin scheme. And also farming land. Yes, there's GST, but again, there's potentially no if it is a business being run. So in conclusion, property and tax is determined on the facts and the intentions. So that needs to be delved into a little bit before we can determine what the tax outcomes are. Again, intentions can change. You can buy the property originally just for investment purposes, but then later on the track decide to do a property development. So tax can be determined a bit later on as well. My advice to you is seek advice first before the actual transfer goes through, because it is a minefield. So we've talked with Laurie about doing something with property. I've scared you with tax. Now it all hinges on whether you can actually get the finance right. So I will now hand over to Tim Gasper.
Sorry, that would help if I unmuted. I'll start again. I was just saying what a great guy Stu was. No one heard that, so I'll keep going. Just a quick intro about myself. I've been in broking now for more than a decade. Do a lot of work with investors and people looking to do development finance. I'm a mortgage broker. Most of you have dealt with mortgage brokers, I'm guessing, by this stage. But where we are different from many mortgage brokers is that we are not a one-man operation. So we've got a team of people that help look after our clients. So that is a bit about me. Now we're just waiting for the slides to flick. Beautiful. Okay. So financing for investment or development at its most simple is very much like getting finance for a home loan. It comes through the same part of the bank, and it's the same policies and processes that are involved. And we'll have a look at those in a second. But at its most complex, commercial finance is a very different beast. It's handled by a different part of the bank, and the considerations are very different. Either way, what's really key for a borrower is having a really good grasp of their current financial position and understanding how a bank will see it, and knowing what value you have now and are going to create through the project that you're about to embark on. So what I've done here is prepared a table that shows you a bit of the contrast between organising lending in simple and complex scenarios. So if we're looking at a residential development, maybe putting a house on the back of a block, or clearing a block and building a duplex side by side, anything in fact up to 4 dwellings on the property, we're probably going to fall into the residential simple finance space. In these scenarios, typically developers or the people embarking on the project are looking to retain the properties at the end. And to do this, they're going to need to be able to show that they can service the total debt that they're asking for based on their income and rental income from the properties that are being built. In these scenarios, affordability is assessed exactly like a home loan application. They're looking at income, they're looking at commitments, they're looking at living expenses. And the other part of it is ascertaining what the value of the property is going to be, because they need to know, the banks need to know they've got enough security for their lending that you're asking for. So overall strength of the deal does come down to asset position, maybe super to show how you can clear debt, and debt to income ratios become a significant factor as banks worry about the current economic climate and want to make sure that you are not over leveraging yourselves through a project. Typically, you can borrow up to 90% in these scenarios, although you'll pay mortgage insurance if you're going above 80%. And rates are residential investment rates, which for variable rates are somewhere between 3 and 3.5%. And right now, fixed rates are actually lower than that quite considerably. So how does that contrast to complex lending? Well, we're usually looking at either commercial or above 4 units on a site. And we're also looking at a situation, and this may apply to where there are less than 4 units on the site, but the means of exiting the project is going to be by way of selling one or more of the dwellings, so that you cannot afford to keep all of what you're building, and you will need to sell some or all of it, in which case considerations push it into a complex finance situation. You still need to be able to show that you can afford whatever debt is going to remain at the end of the development, but you're also going to need to be able to establish typically pre-sale. So you'll need to sell off the plans, some of what you're building, to satisfy the bank that they're prepared to fund what you're going to need to do the development. Therefore, the way they assess affordability is quite different. They're looking at interest cover through the project. They're not so much focused on affordability at the end. And they're going to look at a range of other things when they're assessing the application. So they want to know what your experience and track record is in development, who the builder is, what their experience is in doing this type of project. Is there a project manager involved, or you looking to do it yourself? These are all elements that, when put together, will give the bank confidence about the project and therefore more likely to lend. And the last point there is pre-sales. The amount that they'll lend in this situation is typically less, in that they want more security. So it could be 65% of land and construction costs. In some cases, you can borrow up to, say, 75% of the total on completed valuation. And because it's complex and because it's in the commercial space, you are looking at higher rates and fees, and these would typically start from 3.5% and up, and could be up by several percent. Other talking points in relation to finance for investment and development. Obviously, as Stuart's talked about and Laurie's mentioned, ownership structures are really important for both asset protection and tax effectiveness. And stamp duty, and this comes in particularly for investors who are looking at the idea of buying a block, maybe with a friend or with family, and in time subdividing and building two on a block. Every time you transfer titles, you create a dutiable event, and you need to plan ahead to minimise that. Stuart, is well placed to give you that sort of advice as to how you go about doing that. But obviously, if you've got to pay 5% stamp duty on every transfer, it's a significant amount of money that you want to avoid having to pay if planning would allow you to avoid it. Just briefly, the impact of COVID. Lending is hard, but it's not impossible. Lending will certainly get easier over time. Lending is always cyclical. I remember in the GFC, banks really dried up what they were prepared to lend, not just in a commercial space, but even in a residential space. And 3 years down the track, they were out there aggressively seeking business. So this too will pass in terms of lending being difficult. But typically what we are seeing is that they will lend, they're just asking more questions. So they want to know about how COVID is impacting your financial position, how it's impacting your income, and they may ask for more documents to verify and support what you're telling them about that impact. And in the commercial space, a lot of development finance is now being done by non-bank lenders. The big four banks are very risk adverse at the best of times, and probably more so right now. So developers are looking elsewhere for finance. Now, a quick case study. I mentioned a dual occupancy before. So a client of mine bought a property in South Caulfield, would be worth around 1.5 million. And they had a loan on that property for about 1.1. When they came to me, they wanted to build a dual occupancy on the property, and the cost for that was going to be 1.3 plus. The plan was to keep both and rent them out, and the rental return was going to be pretty solid, 43,500 per dwelling. And the commercial case for doing it was good because he estimated that they'd be worth at least 1.75 each, so that if he ever needed to sell, he'd be able to realise a good profit. So total land was going to be about 2.4 on an asset that would be worth 3.4, and the client could afford that, so everything looked pretty rosy. Through the process, though, we did have some hurdles, and that is pretty much the name of finance. There are always hurdles to navigate. The first one was the client wanted to use a contract with the builder that was going to see the builder paid an amount every month based on the percentage of the work that's done. That's not a standard HIA building contract. It's certainly more common in larger developments, but we were trying to do this through residential investment lending, and the banks just said, no, we won't do that. That's too much extra work for us. So we had to work with the builder to restructure that contract to one that the banks would work with. The second hurdle we came across was the bank valuation came back at 2.8, which is significantly lower, as you can see. And that was because the bank will value these projects with what they call an inline valuation. So they value it as 2 properties on 1 title, not 2 properties on 2 titles, even though at the end of the process, the client is going to subdivide so that they're on separate titles. So obviously there are a whole lot less people in the market who are prepared to buy 2 houses on 1 title, and as a result, the valuation drops back. So in the end, the client had to either contribute more funds or put in another property as security to make the deal work. They chose the latter, and this project's now well advanced and marching towards completion. So we've been able to help them through the process. And lastly, just a general observation, it's really easy to make mistakes as you go through finance. It is a very complicated space. Risks can, if you make mistakes, they can have huge consequences, particularly in the investment and development space. So it's really handy to use an expert who can guide you through that process. I've given you some examples of some of the things that can come up and can go wrong. And using a broker that has had experience with these sorts of transactions can help you navigate it, keep the deal on track, and ultimately let you get projects off the ground that might otherwise flounder. So that's all I've got to say for now. I'll hand it back to Stu.
Am I muted? No, cool. Right, that's cool. Thank you very much, Tim. Let's just do a couple more slides. So we've come to that time where there are some questions. If there are any questions, if you've popped them through the chat section, that would be great. I'll just go to our contact details if you want to reach out to any of the presenters there. They're on the screen at the moment. But Lakin, do we have any questions?
We do. So we have a question: if GST payable on residential as well as commercial property?
Yes, so the answer is yes. And also it depends. It depends on whether the commercial property was in line with the business. So if they do sell that commercial property and it's a business attached, you can get exempt from GST. And with a residential property, often if it's a new development, so it hasn't been lived in or it's been less than a year, less than 5 years old, there potentially is no, there's potentially GST as well. But there are concessions to reduce that GST, being the margin scheme. So hopefully that answers your question, but please give me a call if you want to go through further with that, that topic.
All right. If you refinance an investment property and use the equity for another property, is there CGT implications, or is it purely based on capital growth from purchase price?
So in that circumstance, the property hasn't been sold, so there's no CGT calculation. All you've done is refinance. So again, there's no transaction, so no issue in relation to CGT.
But if you do sell it?
Sorry?
If you do decide to sell it, then you will have the CGT?
Correct.
Great. What timing should we engage town planning in the process?
Me, thanks, Larkin. Well, probably you can see from all the stakeholders that come through the process, ideally at the very first idea when you've got a concept for development, it could even be pre-purchase. We do a lot of research and due diligence pre-purchase advice to see, is it in the right zone? Can you achieve what you wish to achieve on the property? Sometimes I get calls from those wanting to develop a site and find if we delve a bit deeper that council actually looking for greater development. And it could be the other way around as well. So the earlier the stage, the better, and certainly having input to the design.
Cool. Was there any other questions? No other questions? Does anyone, you can unmute yourself, does anyone have any more questions for Tim, Laurie, and myself?
I just have one quick question, Stuart. Is there a way I can access this particular PowerPoint?
Yes, we can shoot us an email or shoot me an email. My email's on there at the moment, and we'll see if we can get you that PowerPoint. As I mentioned at the start of the presentation, there will be a video of this going online, and we can send that across to you as well if you want.
Perfect. Thank you.
I've had some more questions sent through. Tim, in general, how often should we be reviewing our interest rates?
Right at this point in time, frequently. But as a rule, I would say every couple of years is a good time to review rates. Lending is constantly evolving. Banks' appetite for business is constantly changing. And rates that we set up for clients 2 years ago now look unattractive compared to what is available now. So yeah, every 1 to 2 years, it's worth having a chat with your mortgage broker and finding out whether what you've got is as good as it ought to be.
Stu, we've got another question around CGT.
Awesome.
If building a second dwelling and subdividing a property you've lived in for 10 plus years, if you move into the rear property, are you exempt from CGT after 6 or 12 months?
My answer will be depends. So that's a pretty specific question there. So if you wanted to give me a call so I can take that offline, because I'm pretty mindful of giving the right advice. So I just need to know a little bit more involved. For example, if this was your second development or third development would be a different answer depending on if this is your first or et cetera, et cetera. So that'd be great if I can give you a speak to you first. I don't want to give you the wrong advice, I guess.
That's all I have that have come through. If anyone else has any.
Well, that's great. I might finish off this webinar there. So I'll stop sharing. Thank you very much for everyone to coming along. I'm hoping you've got some value, and please feel free to contact Lorenzo, Tim, or myself if you've got any specific questions. And thank you very much for taking the time out to understand a little bit more. We will be running a couple more seminars throughout the year, so please drop us a line if you've got any ideas. Cool.